Let's just look at 30,000 startups over 30 years. US, Israel, and Sweden. Essentially, what can we learn? Well, it doesn't really matter where you are in terms of survival. Wherever you are, roughly 50% of those that get VC capital get a successful exit, defined as an IPO or an M&A or a secondary. However, how that exit looks varies quite significantly. Now, if you're looking at survival, industry is essentially the one thing that matters the most. Software has the highest chance of surviving to a successful exit, while if you're looking at industrial manufacturing, that's at the bottom end of that scale. But if you're looking at the exits, the biggest thing is what they look like. In the US and to a degree in Israel as well, there's a big X factor, and say that it's roughly 10x over in the US. But if you're looking at contributing factors, there's also 10x on the capital in, so there's a clear correlation there. If you're looking at the best exits, you essentially always end up in Silicon Valley. There is a statistical significance between the valuation of a startup and it being acquired by a US tech giant. So there you have it. Now, if you're looking straight into the European Union, and especially we've deep dived into clean tech, because everyone cares about that today, and health tech, which is a subdivision of life science, which sort of focuses on human health. It is interesting that Sweden does sort of preside. We have a couple of clusters that are in the top 20, but we're still lagging. We have a couple of heavy-hitting exits, but so the max exits are up there for a few single occurrences, but in general, mean and max is pretty low, and you can see the correlation also. There's a lot less money coming in, and there's a lot less money coming out. Now, the only thing that is unique about Sweden, and we're not going to talk in depth about it, it is the secondary stock exchanges, which essentially don't, in a practical sense, exist in other places. So they've proven to be, although they have a bad rep, quite capable of providing a trampoline second chance for a lot of companies. Now, what limits exit? Now, let's just look big picture. Most venture capitalists invest over a 10-year lifetime, which means that they have to sell essentially when you reach the end of this. Yes, you can go into overtime for another 2 years, but there you have it. So, and it's the last years that most of the value is essentially built. Meaning, if they're slow to start and you start this 10-year timer, what you're cutting out are the last years. So the big difference is in the US and everywhere else, more investment early phases, they track, they grow quicker, and they have longer time in the later phases to build a lot of value. Finally, now take this into perspective. If you're looking at things that take a long time to grow, and on top of that, like deep tech that is extra long, and you have these slow early years, you're essentially kneecapping the growth value lifetime. So in a way, it's interesting that NATO and a couple of other big players are moving to a 15-year life horizon because it allows you to have those extra 5 years to actually grow and create value. Now, I think I've made my 4 minutes. I'll stick around and talk more later.
Thank you so much, Pelle. My name is Filip Hansen. I'm a partner with BCG, work as part of our financial sponsor team, which means I work with transactions mainly in the private equity space and in venture capital. I will talk a bit about what we've seen in the Nordic exit environment during 2024. I think 2024 was a very inspiring year, and we will talk more about that. First, just a few reflections, building on some of the points that Pelle made also about the environment that Nordic companies operate in, especially when it comes to exits. So we heard many interesting points previously on early stage access to capital. I think when it comes to later stage access and exit opportunities, the Nordic countries stand out in some interesting aspects. I see we're missing some of the flags on the page here, but if we look at access to equity capital, which is what the graph on the left-hand side shows here, we see that companies in the Nordic regions are, first of all, much more likely to consider equity a realistic financing option. Secondly, when it comes to IPOs, interestingly, on the left-hand side, the share of capital raised through IPOs in Nordic countries is about 5x when you compare it to the European peers. And thirdly, when you look at the private capital side of things, so private equity, venture capital, these are much more mature and well built out markets in the Nordics. I think Sweden stands out here as the outlier, but the other markets as well when you compare to the European average. So while if you were to compare these numbers for the EU as a whole versus US, it would be a pretty depressing view for the EU. When you do it for the Nordics, it's definitely more positive, and I think it's part of what also allows us to see great exits year on year in the Nordics. Now, looking at what we've seen in 2024, here you see just a summary of we've looked at the largest exits over the last 10 years. You see the summary of the total value on the slide. So 2024 was a very inspiring year. It was a strong year, and you see the value was the highest in the period, with the exception of 2021. And in particular, the value per deal, which is represented by the line on the graph, which was very high. So we had a lot of basically very high value deals and exits in 2024, which is a testimony to all the great companies created, of course. Then if you just take the country perspective, we see Sweden continued to do very well. Norway had an exceptionally strong year, which was great to see. And I think it's also, based on the previous discussion here as well, very exciting to see the industries where these companies operate. So even though there are a lot of challenges, especially when it comes to early access to capital, etc., it's clear that we continue to build very strong technology leaders, and we continue to be at the forefront of healthcare innovation, as well as on the climate transition. So just very briefly around what we see in terms of outlook for 2025 and the exit environment in particular. So while we, of course, continue to operate in very volatile and uncertain times, we see the macro indicators as a whole pointing to an improving exit environment. So more M&A activity, more VC fundraising, more active IPO markets. And hopefully with that, we'll have a lot of interesting exits to discuss also next year when we meet.
Great. Thank you so much both for your presentations. So if there's one thing that you want the audience to take away from what you just said, what would that be?
Me first? It does matter if you're an entrepreneur or an investor, I'd say. An investor, for the exit, it's essentially the payout, and it's primarily financial, with financial rewards and financial risks. However, for the entrepreneur, it does affect much more on a personal level, because if it's an IPO, you keep going more or less like you did, but on a different scale. However, if it's a trade sale, you're essentially part of the package being sold. So you get based on your perspective, you have a different ballgame.
Filip?
I agree. I would also say, I mean, in the current narrative of European growth, productivity, innovation crisis, and I also subscribe to everything that was said in the previous discussion. I think we do a lot of things right in the Nordics, and we do create a lot of successful, innovative companies. And while we certainly can do a lot to improve access, I think we have a very strong position, and it's exciting to see, especially the sector split of the companies that we're creating and scaling.
Well put. Thank you so much both. Give them a warm round of applause. So, Per, you're not alone in the panel. So, can we please give a warm applause to Staffan Truvé, CTO and co-founder at Recorded Future? Peter Wolpert, CEO at Industrifonden, and Klementina Österberg, CEO at GU Ventures. Welcome. So, Peter, what are the most critical factors investors focus on when guiding companies towards a successful exit? And how important is it, do you think, that entrepreneurs present a clear exit strategy in their initial pitch?
Well, if I start with the last question, I think for us, it's not important to see the exit strategy. We want to see a good strategy and roadmap to build a great company. So I think that's absolutely the most important, that we understand what are the value triggers. If you look at the tech and product, if you look commercially, financially, and maybe a little bit underestimated that you really think through how you will develop the team over time. So all of those combined, we want to see a value creation roadmap. And over time, if you build a great company, there will be exit opportunities. So I think it's very seldom that we focus on that initially.
Staffan, what are the most common challenges the startups face when preparing for an exit, and how can they sort of proactively address them?
First of all, let me just agree 100% with what you said. I think the most scary thing is when people start a company with the idea about an exit and not focusing on how do you build value, how do you build a successful company. So, I mean, I think that's what people should focus on. I think you're doing yourself an unfavor if you see that as the goal. I think you have to understand that you're in it for a very long time. Maybe one thing which is important, I would say, is to have some idea maybe about the time scale. You know, I think people are always, we are all over optimistic, otherwise we wouldn't start companies probably. But realizing that this is going to take you 10 years of the best 10 years of your life you're going to spend on doing this. So I think having that time perspective is the most important.
When you're nodding. Yeah.
There could be one thing that I would, bring up that you could think of early on, and that is really when you're setting the legal structure, if you're thinking about that there could be different exit alternatives, you may need to think about, especially if you're in a regulated environment, in which entity do you put, for example, regulatory approvals and so on, quality systems and so on. So, for example, when we sold Moberg Pharma, the commercial business of Moberg in 2019, we had a US business, we had a European business with different regulatory approvals, and I think we benefited a lot from having thought through the legal structure and making sure that the entities, because there was a carve out, it was a trade sale of the commercial business, and to have that very clearly set up from the beginning helped a lot.
Can I actually protest a little bit? Because I'm thinking like this. Of course, you as a startup, you don't need to focus on the exit. But to be frank, if you haven't sort of prepared yourself in your mind that this is what I'm going to do, this is the timeline, this is the value creation, you still need to be a little bit prepared. Because I know when I negotiated with Peter in our last investment, that you still needed to have that timeline in your sort of mindset. Even though it's not focused, we didn't want to hear anything about any entrepreneur saying, yeah, I really want to sell the company right away. But we still needed to be prepared for that going to come up in a negotiation. How many startups are here in this room today? Okay. So I don't know. You either trust these advices in some way, but I think that if
finally some debate.
If you're not prepared, you're out of it.
Pat, you're raising your hand as well.
Well, since everyone's jumping in, I just got to take the chance. Now, if we take a step back, research in the US shows that venture capitalists won't invest unless they have a pretty good picture of how it's going to be sold one day, because they're expecting a sale, because 97% of successful sales are essentially trade sales and not IPOs. So as an entrepreneur, you should focus on building a company, but the investor will start figuring the exit from day one. So you got to be prepared for that.
And Pat, so what exit options should startups then consider beyond the traditional IPO or acquisition, and how can they sort of identify the best fit for their business?
So baseline, the traditional ones are the best one. That's why we only talk about them. If you're looking at the rest of them, they are essentially second choices.
What are the rest of them?
Oh, well, you got the secondaries and you got the management buyout and everything else. But usually that is further down the sort of line where you can't either list the company or sell the company. So that's where you should focus. And was that the whole question, or sorry?
How can they identify the best fit for their business?
So the best fit is, if you're looking at the IPO, just look, is this a market where, are we in an industry where IPOs are sort of the standard way of doing it, such as pharma, clean tech are moving in that direction, while other ones don't move in that direction. So you got to understand the industry logic. On top of that, you look at what are the big players buying if you're looking at the trade sale. You're going to make the most money, profit maximize, if you're going to sell to one of the big players. And having what they're looking at the time where they're sort of looking at acquiring that technology or that kind of, that piece that fits into their puzzle in their product pipeline is probably one way of maximizing. Now, I could go on, but that's a different lecture.
Anything to add?
I can actually add one thing to qualify something I said before. I think, because we were a bit vague here, it's of course hugely different if you're talking about your first investment round, whereas if you're 5 years into your company. I would say honestly that if I were doing a first round investment and someone asked me about the exit, I would just close the door and walk away from that. But if you're some years in, of course, you know that your early investors have some horizon. They need to think about that. So I think it's maybe most important to look at your different stage investors, how they can align their goals. Record Future is a great example. So 5 years ago, we were approached by a huge US tech company who was interested in buying us. And then one of our investors said, laughed and said, at that valuation, we are not actually sellers, we're buyers. And our other investors said, great. So they actually bought out the other investors. That's a sort of different kind of halfway exit you could do. So I think this thing about that you have different investors, they came in at different times, they will not have completely aligned interests. I think that's something you need to think about.
So Klementina, since early stage startups focus primarily, like you said, on building strong companies, at what stage should they then start actively considering exit strategy?
Well, first of all, it's what I'm also meant about being prepared is one thing, and but when they really need to start working on it is when in the process when you need to be aligned with your owners, and it depends totally on what type of investors you get in. What actually the major shareholders think in this matter. So even though we try to prepare everyone in the very early stage just to have that mindset that, okay, let's see if we have the researchers and the entrepreneurs or other key personnel, even board members that are owners, what are their individual goals? And also in the next round, who's going to enter in that round, who's going to invest, and maybe in that phase this exit strategy is even more important to just align between the owners. So we try to prepare them that they know that this could be different sort of changes coming up in the future, and you will never know what actually the IPO will mean either. And also in that IPO situation there are definitely possibilities when entrepreneurs are actually deciding that, I'm not going to drive my company to the next level either. So I'm going to step off now. How we also solve that situation. So it's going to be different for different companies, I guess.
Staffan, can you elaborate a bit on how entrepreneurs should approach value creation sort of over time to maximize their exit potential, and what key milestones do you think that they should aim for?
As I said before, I'm a very simple person here. I think value comes. Actually, let me quote Daniel Ek. I love this quote from Daniel Ek, which says that the value of your company is the number of problems you solve, and that's, as I interpret it, the number of problems you solve for your customers. I think that is the key thing. So value comes from the money you make from your customers. Very simple. And I think you just need to understand that. How can you grow the company? There is really no either value. Of course, there is value if you build some unique technology which you miraculously sell to someone. But I think bottom line, it's very, very simplistic. It's revenue from paying customers is what builds the value in the end.
Peter, did you want to add something to?
Yeah, maybe just that's one part of the or one type of companies when you are revenue generating and profitable. But of course, we have a lot of tech companies that are not looking at it from that perspective, and then
that's a big problem.
That's a big problem. But in some industries, that's also the standard way. If you go the pharmaceutical route, you need to understand where do you create value, what does the pipeline look for, the potential buyers in that category. So of course, you need to design the strategy according to the industry. You need to understand the potential buyers and your potential customers.
Let me just sort of quickly say that I think you're right. I mean, pharma has developed a very interesting different logic where you have the early stage companies which they eliminate some risk, and therefore they can then be sold on to the larger pharma companies who are really marketing organizations, right?
Exactly.
But that and there are maybe a few cases like that in tech in general, but much fewer, I would say.
Agree.
It's a totally different business model.
Yeah.
So Klementina, how can founders then ensure alignment between different stakeholders? You have investors, you have board members, employees when it comes to exit strategies. How do we align?
That's the $10 million question, because it's really tough to all the time getting that alignment in place. And we talk about it a lot. We talk about it with every owner, and it might be difficult for some companies. And I would just recommend everybody to solve that problem in an early phase. And even if it's, you're not getting aligned, just like you said, if somebody then says, okay, buy me out, so then you solve it that way. I guess.
I just bought out all the owners in my company. Fix the problem.
Good.
Fantastic.
Yeah.
Well done.
Well, statistics don't say that 50% of the companies fail because of conflicts within owners. So it is stakeholder and especially owner management is critical. We don't talk about it enough.
Yeah.
I came in as an external CEO, and then that happened. So I wasn't from the start. But Per, so how do external factors such as marketing trends and economic conditions impact exit timing and strategy?
Well, it's crucial, of course. Timing is crucial for most things. It's crucial for success, and I could go on and on. But, well, if you're just looking at the IPO market, that will go up and down. And of course, it's much easier to list a company when the IPO market's hot. However, what you often don't sort of think about is at the same time the IPO market is hot, by all means, the M&A market will be as hot. So essentially, it's a double win if you're in a good market, and it's a double loss if you're in the back market. But it's easier to sell a company in a sort of Siberian climate than listing a company. So there's that. But there's also two other aspects. It's sort of a lot of the big players are moving on big trends. And if you can sort of time having the right thing at the right time, and that's not just revenue, but having the crucial technology that if you're selling 10 million and a big player can pick that up, put that into their product pipeline and put that into 1 billion within the next 3 years, you're sort of in the sweet spot and you're getting the timing right. But there's a third aspect of timing that you don't often talk about, and it sort of relates to when I started. You got to look at how much time are the investors willing to wait. Because if you brought in investors, VC investors, they have a 10-year lifetime, it's already gone into extension, and they're saying, well, we got to exit. It doesn't matter if you double the value or triple the value if you're given another year. When they're going to sell, they're going to sell. And if you don't want to sell, tough shit. So timing is everything.
Azra, maybe going back to the previous question also, I think what we do when it comes to the different perspectives of stakeholders, we're trying to establish a shareholders agenda very early. It's often a very brief conversation in the beginning, and it gets more sophisticated over time. So I think to make those things, have those explicit discussions, making sure that you update that maybe annually, that we find very useful.
Thank you. And we want to end this session on a positive note, right, Klementina?
Yes.
Yeah.
I won't protest anymore. Maybe you can help me out, Azra.
Absolutely.
Because it was an idea we had together with Boston Consulting Group, BCG, and Filip had to leave early. But Azra and me, we want to congratulate one of the 2 biggest exits in 2024, one being done by Staffan and another one by Peter. So give them a big applause.
Well,
Massive congrats.
tack så mycket.
Så mycket. Tack.
And just to add, it's just to add the last thing, it's because Industrifonden and many other owners sold Caliditas on a stock exchange.
We were one of the
Yes.
first investors, so we're very proud, but it should be Bengt Hylander, it should be René that really, this prize is for them.
We have another one for him, so we'll send it with you.
That's great.
Thank you so much. Give our panel a warm applause.